Hello and welcome to Outlook Money's Investment Made Easy webinar series. This episode is spearheaded by ICICI Prudential Asset Management Limited as part of the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Varsha Jain from Outlook Money and your host for this session. Welcome to another episode in our series. When discussing equity investment, the primary focus is typically on stocks, followed by other instruments such as exchange-traded fund or ETFs. Stocks have been traded in the market for a significant period, while ETFs were introduced only around 22 years back in our country. Investing in stocks grant partial ownership of the company to the investor, whereas investing in an exchange-traded fund involves exchanging units in the ETF without ownership in the company. While purchasing a stock entails investing in a single company, buying an ETF means investing in hundreds of securities. ETFs are passively managed fund and replicate the performance of an underlying index. Today's discussion will revolve around stocks and ETFs, exploring what they offer, who they are suitable for, and when it's best to invest in them. To delve deeper into this, we have with us Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, and Mr. Nirav Karkera, Head of Research, Fisdom. Welcome, Mr. Haria and Mr. Karkera.
It's a pleasure, Varsha.
Okay, so without delay, let's begin the session. So, Chintan, to start with, could you please elaborate on the advantages of investing in equity and specifically focusing on investing in stocks and ETFs?
So if we look at, let's begin the journey. As individuals, as consumers, we buy goods and services. Most of these goods and services are produced by companies. We all know all the larger companies, they're pretty prominent. And if you want to invest in those companies and gain from the profits that you're making for those companies by purchasing the goods and services, the best way is to invest in them, in the companies, and participate for the long run. Now, investing in this journey of the companies, and this journey of the companies is exactly the same as your journey as a consumer. You demand their goods and services, the companies grow if they are doing better. Different companies at different points of time come and go. So companies come and go, but you as a consumer stay, and you as an investor also stay. So for you to participate in the equity journey of these companies, you invest in individual stocks. Individual stock investing, of course, entails you knowing a particular stock, then the sector, then the management, then the competitive intensity, then whether the stock is doing better than the other stocks. Is the balance sheet good? Is the company able to grow? Is the company well regarded in its fraternity? All of it requires a lot of effort. That's when you go individual stock wise. Now, the other way to invest is, of course, mutual funds, where there are professional fund managers who are doing the duty of managing active funds. More prominent in India also for the last 25 years or so. The third is that you do not invest in stocks, you do not invest in mutual funds, but a category which has caught the attention globally for the last 45 years, and in India, like you mentioned, for the last 20 years, which is index investing or ETFs and index investing. So there you have a particular universe from which you have a particular set of stocks creating a benchmark index, and based on that benchmark index, the asset management companies create an ETF, which is an exchange traded fund, which is a mutual fund traded on the exchange, where the underlying benchmark index is essentially replicated. So simply put, if the benchmark index has top 50 companies in India, the ETF will also have those top 50 companies in the same proportion as the benchmark index. And so for you as a investor, it becomes easy to simply go and buy that ETF to get exposure to those 50 stocks in the same proportion as the underlying benchmark index. You can do it in smaller units. One unit typically is anywhere in the range of 50 rupees to 200 rupees, depending on which ETF provider you are investing in. And you get the benefit of having these smaller unit sizes and accumulating it while they are traded on the exchange at live market prices. So as an investor, just to summarize, you can invest in individual stocks to participate in the growth, but that requires a lot of effort. You can trust your money with active fund managers, which is what you've been doing for the last many years. And much like in the West, now the ETFs are picking up meaningfully. You know exactly what you are going to get because the methodology is set. So if you are aware that, okay, I want to participate in 50 companies at a low cost, let me go the index fund route or the ETF route. then you go for that path, and it's pretty simple. The investing for all three happens through the digital medium. It's quite easy these days. So it is up to you what you choose. We've seen most investors pick all three. Many investors don't do individual stocks, so they pick two. But having a diversified portfolio is what I would suggest for the benefit of all investors. Thank you.
Diversified portfolio is what you suggest. Very well said. Equity holds the potential for significant growth, but also carries substantial risks. So my next question is from you, Nirav. Um, while diversification can help reduce these risks, in your opinion, what are the risks associated with ETFs that differ from those of stocks?
Right. So, of course, as you rightly pointed out, it's important to focus on the risks that are very specific to ETFs, because every risk that pertains to equities is, of course, carried forward into ETFs, apart from the unsystematic risk that is handled through diversification. Beyond that, there are a few risks like tracking error. Okay, so that's something that one talks about at the very outset. It is the differential where an ETF is unable to track the index that it's supposed to track with utmost effectiveness. So there is a slight difference there. It could be attributed to a variety of factors. And versus stocks, another risk could be the cost incidence, which is very marginal at this point in time. It's really low, almost negligible. In fact, ETFs are known to be amongst the most cost efficient investment vehicles. But still, nonetheless, if you were to invest via stocks, there could be a slightly elevated cost angle to ETF investing, wherein there could be management charges that are levied apart from other buying and selling broking related charges. So these are the two primary points of distinction that an investor must bear in mind while choosing an ETF over stocks. This is very specifically from a risk standpoint. Apart from that, largely everything that is held within the underlyings gets aggregated up at the ETF level as well.
Okay, so two main points. First is the cost, and another is tracking error. One needs to be mindful of while investing in ETFs. Chintan, how dependable are stocks and ETFs when it comes to generating dividends, which serves as a passive source of income for many investors?
So as far as dividends are concerned, it is an important element of the decision making that happens when you invest in an individual stock, because dividends basically give you the chance to know that the company is actually making cash flow and is able to give you money out of the profits that they are making. In India, of course, India being a growth market, dividend plays a smaller role, because eventually a company which is good and is growing is able to use the profits, plow it back or put it back in the business and grow the business. So in India, dividend yield is not a good metric we've seen as far as selection of stocks is concerned, but that's a generalized statement. Specifically, if you look at, let's say, 3 years back, 4 years back, many PSUs were cheap and they were giving higher dividend yield as well. Some were as high as 8, 9, 10, 11, 12% dividend yield. And we know what has happened in the last 3 years. So while generally I'm saying that in a steady state, dividend yield should not be a metric for you to decide whether a stock is good or not, it does give you the comfort that the company is making cash flow and is paying out. The consistency of dividend over the last 3 to 5 years needs to be checked. Whether the dividend is growing or not needs to be checked. So again, much like how I said, there is a lot of variables you need to see before you buy a stock. Similarly, in the case of dividend yield also, there's a lot of deep research that you need to do before you select a stock just purely on the basis of dividend yield for your cash flow needs. The better way, I believe, is you invest in a diversified portfolio, be it an active mutual fund or an ETF. Within an ETF, then when you feel that you need the cash flows, you can simply sell on the exchange, and next day with a T+1 settlement these days, you'll get the cash flow in your bank account. And more importantly, when you get the cash flow in your bank account, the capital gains that you will pay will be only on the actual tenure that you've held and the capital gains that you made on the units that you've sold of the ETF. So unlike the case in dividend, where whatever dividend you get, you'll be paying at marginal rate of tax. In the case of selling ETF units, whatever is the capital gain on those ETF units, only on that you'll have to pay tax. And since equities are taxed at an efficient way, you will basically be better off getting the cash flow by selling the unit on the exchange rather than buying a dividend yielding stock for the cash flow needs. So this is what the investors should keep in mind.
Okay. Moving on, Nirav, apart from cash flow and diversification and dividend factors, are there other factors too that investors should consider when deciding between investing in stocks and ETFs?
Definitely, there are a few more factors, and I would say that the first and foremost, the most important factor is oneself, right? So while you can, of course, optimize for market cycles and the instruments that's available, I believe that the decision between equities and ETFs relies heavily on your own capabilities in terms of assessing investment opportunities, right? So if you have the capabilities, the technical know-how, the knowledge infrastructure required to assess thousands of companies that are listed on the exchange and still filter it down to the best set of companies that you would want to back by way of investment, and you have a reasonably high degree of conviction in these companies and are able to size it well, then probably stocks make a whole lot of sense. However, one important point to note is your conviction must also be verified by the market. You must have established a track record of doing well with stocks and stock selection. It is a very rare skill set to be found, and typically it has to be a full day job and a full time job to do this, right? So if this is not your full time job, or you lack any of the above factors like the knowledge infrastructure, the technical know how, or just simply the ability to go through such rigorous research, you then start looking at other options like ETFs and mutual funds, wherein you outsource this decision making to experts, right? So in an ETF, what happens is your decision making becomes fairly simpler. You invest in a basket of stocks that is predefined, predetermined. You need to have conviction in the method, in the rules that are set out for the ETF, and the rest is taken care of by those set of rules and guardrails, right? And the risk itself is also very optimized because of the diversified set of underlyings. I feel a very easy corollary to understand between stocks and ETFs is ETFs are basically a box of assorted chocolates wherein you'll get dark, you'll get milk, you'll get white. Right, the chances are if you do not like dark, probably the milk would work its magic on you, and if not the milk, the white would, right? Versus buying a single large bar of dark chocolate, which is basically equities. You may or may not like it. It's a hit and miss sort of a situation, right? So unless you are really convinced that this manufacturer does a really great job at producing this very bar of chocolate, it's always better to choose an assortment, because if one doesn't work for you, the other definitely will. So I feel the most important thing to consider while deciding between equities and ETFs is your own ability to choose an investment avenue, and your risk tolerance. I feel, in a way, your ability to also back your investing decisions and go through the risks that are inherent to such a decision. So if you want a risk optimized return, probably an ETF is a much smarter choice. If this is not your full time job, then an ETF is a smarter choice. If you want to commit a lifetime to investing, and investing solely as a profession and in some ways a personal aspiration, then probably stocks is the way to go. And eventually, as you grow as an investor, you can add a little bit of the other, always, to gain some exposure and some learnings. But this is how your core will be decided.
Well said, and very beautiful analogy you used. Chintan, people with sound understanding of financial concepts like to invest directly in stocks. But my question is about ETFs. Who could be the target demographic for ETFs? Is it people who want to invest in index fund but use ETFs for faster processing because they can get rates throughout the day, different rates, or those who typically avoid risks and like investing in fixed deposit and but seek exposure to equity?
Some sound understanding of principles which work on an equity or a stock. It's so difficult to actually get a very deep and sound understanding and learning. Fund managers spend 5 years, 10 years, 15 years in gaining that sound understanding, and still sometimes they make mistakes. So for individual investors, to gain sound understanding, of course, is even a more Herculean task, because a set of analyst team, a senior CIO, senior fund managers, all of it make the choice of investing in stocks and diversification much easier for you to invest through the mutual fund route. But as far as ETFs are concerned, they are meant for everyone. There is no individual, uh, category where we can say that, okay, based on your risk appetite, you are meant for ETF. Today, there is such a good diversification of ETFs available. Don't think of ETFs as only, okay, equity, benchmark index, large cap. No. Today you have within ETFs, large cap, mid cap, small cap. Now I think there is a micro cap index available also in the market. You have sectoral, auto, FMCG, or healthcare, or infrastructure, banking, private bank, financial services. You have smart beta like quality, alpha, low vol, momentum. So you have such a wide variety. And based on the individual's comfort and stage of investing, they have so many options to invest in. So I believe, be it a beginner who is investing in the markets for the first time, be it a very sophisticated investor, HNI investor, or be it even large family offices, ETFs are a good way to invest for everyone. They provide you diversification, they provide you consistency of knowing what to expect because the methodology is known to you beforehand. You know exactly what the universe is going to be. You know exactly what is the stock selection criteria for the underlying benchmark index. And you know what is the weightages that are going to be there. And most important, every day the portfolio deposit is disclosed where you know, okay, these are the stocks which are there, these are the weightages, etc. So the ETF route is meant for everyone. The diversification is also there for everyone to choose from. And I would say again, at the cost of a reputation, that have a balanced portfolio where you have individual stock investing if you think you have sound understanding. Many of us think we have sound understanding, but actually when the market really turns, that sound understanding is probably faulty at times. So going the mutual fund route where a professional fund manager is taking care of your investments in active funds, or the ETF route where you are getting the benchmark index diversification without having to worry too much, is a far more efficient way across investor categories. Without any specific investor category, all investor categories can actually benefit from it. Thank you.
Thank you. I want to know from you, Nirav, when it comes to sectoral or thematic investments, would sector-based ETFs be better than direct investment?
Of course, I feel for a variety of reasons it would be a better choice than direct equities, and especially if you have a sectoral view. Firstly, it is slightly, I won't say exactly, but on a relative basis, simpler to have a sectoral view than have a view on a very specific stock. Right. So, even with a little bit of hard work, you can at least get closer to having a view on a certain sector versus the kind of hard work you would require to arrive on a particular view for a very specific stock, right? So it makes sense to play the sectoral bet through an ETF basket. That's one. The other thing is the underlying philosophy that if you really believe that a sector will do well, and you don't have the wherewithal to select which company or stock within the sector will do exactly well, it's better to aim for the entire basket. On a risk adjusted basis, it makes a whole lot more sense because they say when the tide rises, all boats are lifted. Now there are a few boats that will be lifted higher than the others, but at least on an aggregate, on a risk adjusted basis, you will have boats that are tiding higher. And instead of you putting all your eggs into one basket and deciding if one specific boat will rise with the tide or not, right? So another example that I would share is the risk adjusted odds of winning are much better in your favor when you bet on whether it will rain or not versus betting on how much will it rain. Right. So it makes much more sense to take a broader bet, like in the case of an ETF, a sectoral ETF, wherein you're playing the entire sector, and because of the diversification included within it, some of your unsystematic risk is diversified out there, and the odds of winning and making a decent return is much higher and elevated in an ETF. Again, in an equity, drawing upon the chocolate bar analogy, it's a hit or miss. There are chances that you could generate much higher returns than you would in an ETF, but at the same time, the odds are almost equal that you would lose much more than you would on an ETF.
All right. So Chintan, on the surface, it looks like that stocks and ETFs are similar because both operate within the stock market, but beyond this resemblance, they are significantly different. Given the difference, should investors even compare stocks with ETFs?
So, of late, in my interactions with investors across various platforms, there is this debate that my stocks are performing better than mutual funds and ETFs. My stocks have given more return than mutual funds and ETFs. Why should I invest in a mutual fund and ETF when my stocks have done well? And it's true in a market in the last 1 year, 1.5 year, where the small caps and mid caps have done almost twice the return as a large cap index. And mutual funds, as you know, are meant to be diversification vehicles and also better risk managers. So most mutual funds, in terms of risk management and diversification, will probably end up underperforming when there is a rally of the nature that we've seen, underperforming those individual investors who picked a set of, let's say, mid caps, small caps, micro caps, which have done well when the markets do well. But as we've seen in the last 10 days or 15 days in the correction, a lot of it would have probably reflected in terms of the fall in those stocks. So going ahead from here, maybe it will happen that the stock portfolios of individual investors may not do as much as mutual funds or ETFs. So I think one thing which you need to keep in mind is that investing in stocks is good. There's no doubt that you can perform well if you have the right selection methodology, but diversifying yourself and having probably all three is even better because you'll be able to compare across market cycle at any point of time, single point of time. If you are comparing the market with the last 4 years, 2020 March to 2024 March, 4 years post COVID, the small cap index is up 400%. I think the mid cap index is up 300%. So with this kind of rally, or even more, with this kind of rally, obviously your individual portfolios, you may feel that, okay, I'm doing a better job than the fund managers, but those fund managers are having a diversified universe where they'll have large cap, mid cap, small cap in some proportion with risk measures in place, where they'll focus on valuations as well, where the valuations are making sense, long-term sustainability of the business. While your portfolio may have some stocks which have done well, but they may not be sustainable and they may fall off the cliff. So comparing the two may not be the right thing. And hence, I would say, even if you want to compare it over longer periods of time and don't compare it over the last 2 years, 3 years, because last 2 years, 3 years, or 2016, 17, or 2007, 8, or 2006, 7 are not comparable times because the markets were in a big bull run. Look at the entire cycle and then decide whether you are doing better than a fund manager. Most times you will find that the fund manager's risk management is far better than your own risk management. And hence having both in your portfolio to compare is far better over a market cycle. Thank you.
Thank you, very well said. Now, on to my final question, Nirav. In the current market scenario, do you think one should take exposure in equity, be it through stocks or ETFs? And if yes, then what should be the better option?
So the current market situation, as we all know, volatility has heightened, but that is the nature of the beast. That is a very typical characteristic of equities. I feel, the answer that I'm going to share right now is much more applicable to equities as an asset class over a broader time frame. Not just during current markets, and it makes sense for any long-term investor into equities, and anyone investing in equities must be a long-term investor. So I'll echo a little bit on what Chintan correctly said. Any conversation around performance is incomplete if we do not talk about risk management at the same time. We believe at this point in time, the need for risk management is far more pronounced. Right. And at the same time, I would also say that there is indeed a very solid case to invest in equities. If you believe, many years down the line, probably a decade or even more down the line, the global economy, the world economy is going to be at a much better place than where it is today. It is implied that that will be driven by large corporates around the world, and all such corporates are represented and listed on most exchanges, right? So when I talk about equities, not just Indian equities, there's also international equities that we talk about, right? So they will be the drivers of such economic advancement. Now, if these corporates are going to be such important drivers of economic advancement, it is almost imperative that you partake and participate in this journey that these corporates are driving. right? And you can participate by way of ownership or by way of equities, right? So it all finally funnels down in you basically betting on the progress that mankind is going to make over the next couple of years and decades. So if you believe that we are going to be in an economically much healthier position and stronger position as mankind collectively, or as Indians, if we are Indian investors, it does make sense to invest in equities today, albeit while having risk management at the center of your strategy. And this is where you decide between your instrument of choice. If you have the ability, once again drawing upon something I mentioned earlier in the conversation, if you have the ability and wherewithal to select equities, by all means do it. Direct stocks, please do it. If not, it does make sense to outsource such good decision making to fund managers and investment professionals who design products like ETFs, who manage products like actively managed mutual funds, and let the experts do the job on your behalf and help you ride this entire journey of economic progress that I just spoke about. So yes, definitely a case for investing in equities, albeit with a very conscious approach to risk management and choice of instrument.
Thank you for shedding light on this. Of course, equity investment requires longer time and then only it can grow. Everybody says the same thing. And investors or people who have invested in last few years, particularly last 3-4 years, as Mr. Haria said, if they see that their stocks has grown more than the ETFs or mutual funds and they feel confident, they need to again think about the performance and their expertise on the subject. What outsourcing, as Nirav said, outsourcing is important because if you do not have the expertise, seek out the expertise from others. Thank you for providing insights on the topic. With that, the Investment Made Easy webinar draws to a close. We extend our gratitude to Mr. Haria and Mr. Karkera for their participation today and for sharing their valuable insight with us. Viewers, we trust you found the discussion engaging and enjoy the session. Please don't forget to like, share, and subscribe to our channel to stay financially informed. We welcome your suggestions, feedback, and questions at letters@outlookmoney.com. We'll be back with our next episode soon. Until then, stay safe, stay active, and stay informed.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.